Good morning. I'm reporting from Houston, where the energy sector continues to anchor one of America's most resilient commercial real estate markets. Today is August 18, 2026. The Houston Metro is navigating a nuanced landscape, mortgage rates holding firm at 6.67%, inflation moderating to 3.4% year-over-year, and employment remaining solid at 3.7% unemployment. We're going to break down what this means for investors, developers, and tenants operating in this sprawling Texas hub. Let's start with the macro conditions shaping Houston's trajectory. Houston's commercial real estate environment reflects a broader American economy in transition. The 30-year mortgage rate sits at 6.67%, holding within the range we've tracked throughout the summer. This persistent rate environment continues to compress cap rates for institutional buyers while favoring longer lease terms in the industrial and logistics sectors, where Houston maintains significant competitive advantage. The Federal Reserve's policy rate stands at 5.33%, an estimate, signaling that rate cuts, if they materialize, remain measured and gradual. What this means in practical terms: capital is still expensive, but it's flowing. Let's examine the specific metrics that will guide Houston commercial real estate decisions over the next quarter. First, the 30-year mortgage rate at 6.67%. This is the baseline cost of capital for any long-term commercial real estate financing. For a typical institutional loan on a stabilized asset, you're looking at loan rates running 150 to 200 basis points above the 30-year mortgage equivalent. That puts commercial financing in the 8.17 to 8.67% range for most borrowers. Second, the Fed funds rate at 5.33%. This is our North Star for understanding whether rate relief is on the horizon. Markets are monitoring every Fed communication for clues about 2026 trajectory. The Houston commercial real estate story in August 2026 centers on three critical trends that will define the remainder of the year. First, industrial and logistics resilience. Houston's port, rail infrastructure, and proximity to Mexico position it as an unmatched hub for supply chain activity. Even with mortgage rates at 6.67%, institutional investors are actively underwriting build-to-suit facilities for third-party logistics providers and regional distributors. The trend here is straightforward: cap rates are compressing for premium logistics assets, but availability is limited. For developers with land, now is the time to move. Second, office market recalibration. For investors and developers actively working Houston markets, the picture is clear. Capital discipline matters more than ever at 6.67% mortgage rates, but the fundamentals that have driven Houston commercial real estate for 3 decades remain intact. Unemployment is low. Population is growing. Supply chain demand is real. At RipplEffekt, we track over 40 submarkets across the Houston Metro. We analyze lease comps, cap rate compression, and tenant pipeline data weekly. Visit us at RipplEffekt.com for the full intelligence brief.